Students, the next concept which we are going to discuss is the factors affecting the choice of capital structure. So the capital structure means proportion of debt and equity in the business. So here there are some factors which affect the choice of this proportion. Let us see which are those factors. The first factor is the risk consideration. Use of debt increases. When we make use of debt more in our business, then there are two risks involved in that. The first one is the financial risk and the second one is the business risk. What is financial risk? Financial risk refer to the position when a company is unable to meet its fixed financial charges. So when a company is unable to pay off its liabilities, or we can say that loan taken, that all comes under the financial risk. And business risk means depend on the fixed operating costs. So these are some of the examples given in front of you. Building rent, insurance premium, salary. These are some of the fixed operating costs. And higher fixed operating cost means what? Business risk will also be higher. If a firm business risk is lower, its capacity to use debt is higher and vice versa. So before making a decision about debt, we have to see whether our financial risk and business risk is under control, that is, it is low. If these two are low, then we can go for increase in our debt. So first point is risk consideration. The second point is cost of debt. So children, if cost of debt means the expected rate of return of lenders on debt capital. So how much is the expected rate of return expected by the lender on the debt capital? Okay, so that is known as cost of debt. So more debt can be used in capital structure if cost of debt is low. So if our interest rate is low, then we can go for more debt. Next point is tax rate. Since interest on debt is a tax deductible expenses, cost of debt is affected by the tax rate. So there is a connection between interest on debt and tax rate. What is that connection? A higher tax rate makes debt relatively cheaper. So high tax means what? Debt becomes more cheaper. Hence, more debt can be used. So the situation where the more tax is there, so if the taxing policy have increased the rate of tax, then we can, at that time, debt becomes a cheaper source. Okay, so that is one factor for capital structure decision, that is tax rate. Next is the return on investment. We have already discussed in one of our previous slide that return on investment of a company, if it is higher than the rate of interest on debt, it can use more debt to increase the profit earned by the shareholder. So this is also known as trading on equity. So through an example in which we have discussed 3 different cases of debt, we got more detailed information about rate on investment. So if rate on investment is higher than the interest on debt, that is rate on interest on debt, then we can use more debt. Okay. Fifth point is cash flow position. The size of projected cash flow must be considered before borrowing. So before borrowing, we have to first of all see the size of our cash flow. So cash is required to meet the following 3 obligations. The first one is for normal business operation and for investment in fixed assets, and the third obligation is for meeting the debt service commitments. So for all these purpose, cash is required. A company uses more debt if it can generate enough cash inflow to pay interest on debt. So more debt can be used if they have their cash flow position or inflow of cash is high, then they can borrow more monies as they are in the position to pay interest on that debt. The sixth point is cost of equity. Use of more debt increases the financial risk faced by the shareholders. So if you are increasing the debt in your capital structure proportion, that will increase the financial risk which we have discussed earlier. So increase in financial risk means what? You have to pay the borrowed money of debt with the interest attached with that debt. So that all makes the shareholders to face the financial risk. So their desired rate of return also increases. So in any firm, debt should not raise beyond a point that should be considered while taking the capital structure decision. Next one is floatation cost. Cost of raising fund is called floatation cost. Some of the examples are advertising, printing prospectus, etc. Public issue of shares and debentures require considerable expenditure. Getting a loan from a financial institution may not cost so much. So you have to make a choice between equity and debt. So while making that choice, the main factor which normally a company look into is the floatation cost. If floatation cost is more, then the equity shares, issue of equity shares is not a very appropriate selection of capital structure. Better you go for a loan. Getting a loan from a financial institution will be a more cheaper one than going for a issue of shares or debentures. Next one is a control factor. Debt normally does not cause a dilution of management control over the business, while issue of more equity may reduce the management holding in the business. So if you are taking two from debt point of view, we can say that management control will be there in the business, because the debenture holder and company is not related in any way. But regarding shareholders and company, the shareholders have the holding on the company. So there is the dilution of management control if you are going for a equity shares. So the control factor is also one factor which will help or which is used while making the capital structure decision. Next one is the flexibility. If a firm uses its debt potential to the full, it loses the flexibility to issue further debt. To maintain flexibility, it must maintain some borrowing power to take care of unforeseen circumstances. So there should be a control on the borrowing factors. Otherwise, the company may lose the flexibility to issue or to go for further borrowing. Next one is the interest coverage ratio. The formula to calculate interest coverage ratio is EBIT, that is earning before interest and tax, divided by interest. So whenever you do this calculation, the answer, whatever you get, more debt can be raised if ICR is higher. So if after calculating this amount, if you found that the ICR is higher, then you can go for selection of debt in your capital structure. Next one is the debt service coverage ratio. So the formula to calculate this ratio is profit after tax plus interest plus non-cash expenses divided by preference dividend interest plus repayment obligations. So higher DSCR indicates better ability to meet cash commitments. So if this ratio is higher, then you can go for increase of depth in your capital structure. The 12th point is the stock market condition. If the stock markets are bullish means equity shares that means equity shares of your company showing a higher position. So equity shares can be easily issued even at higher price in bullish stock market. However, during the bearish phase, a company may find it difficult to raise equity capital and hence it may opt for depth. So the condition of stock market, that is bullish market and bearish market, is also a factor which help us to make decision related to capital structure. Next one is the capital structure of other companies. Sometimes the company go for selection of capital structure depending on the other companies. So debt equity ratio of other companies in the same industry is a useful guideline for planning the capital structure. 14th point is regulatory framework. Every company operates within a regulatory framework provided by the law. For example, public issue of shares and debentures are made according to the guideline of Indian Companies Act 2013 and SEBI guidelines. This has a bearing on the capital structure decision. So children, every company, they have to follow certain law. For example, we can say when we issue shares or debentures, the company had to follow the guideline provided by the Indian Companies Act 2013 and SEBI. SEBI means Securities and Exchange Board of India. So whatever guidelines is provided by these two, they have to be followed by the company while issuing the shares or debentures. So all these things have a bearing on the capital structure decisions. So children, now let us conclude today's class. Today we saw the 14 factors which affect the decision of capital structure. You have to go through these all points, understand the concept and learn the points. Attend the test paper attached. Meet you in the next class with a new topic. Till then, goodbye.